What's going on, guys? Thank you for tuning into this episode of Twin Finance. I am Jackson. Today I'm going to tell you what a bond is. First, let's just get out of the way. I'm not talking like bail bonds, like getting out of jail. We're talking about investment type bonds. So, a bond is basically when a company wants to raise capital, they basically sell debt. So, what they do is say they issue, say, $5 million, say $5 million of 3% coupons, right? So a bond is like they call it coupons, and the coupon value basically states the return that you're gonna get if you buy. So let's just say for this example, we'll just use all of the 5 million. So if you put $5 million in bonds in that company, you'll get that 3% per year. But why a company does this is they say, well, I'm going to still return my investor a healthy 3% so that he actually wants to invest in my company. Could be more, 3, 5, whatever. But this company's confident that when they take this $5 million in, they can grow it at upwards of 3%. So they're saying, I can pay my debts at 3%, but this 5 million, we're going to grow faster than 3%. So they say, oh, we'll grow it at 8% per year. We're going to make our company 8% more efficient, like 8%. This $5 million can give us 8% each year, right? So that's how a company profits off taking on debt. And then essentially what happens with a bond is, guys, is a company will take on that debt, but they only pay back interest. So like when they only pay back interest, it's not like a loan where, like, say you go to the bank, take out a personal loan, and then as soon as you start paying for that loan, you're paying back principal plus interest. No, a bond, they just pay interest. So they pay back that interest to their investors, and then say this bond had a 2-year term, right? 2 years. So at the end of this 2-year term, they have to redeem full value. So this company would have to pay out 3% of this 5 million each quarter or semi-annually until the bond is redeemed after 2 years at face value, which when they have to pay back that $5 million. But it makes sense for the company because say they grew it at, this is supposed to be an 8, say they grew it at 8%, well, they grew it at 8% and they made 5% of $5 million for 2 years. So that's how a company, it's a win-win really, because this investor says, okay, I want to put some of my portfolio into a pretty stable investment, get this 3% return. I'm happy with that. The company says, okay, well, we're going to take in this money and make it more. So really it's a win-win situation. That's why people choose to invest in bonds, and that's why companies issue bonds. So I hope you understand what a bond is and how they work. If you have more questions, just leave a comment in the section below. Thank you for watching the video. Remember to subscribe for more videos like this one. Have a great day.